Welcome back, everyone. I'm very excited. Today, I have a special guest, Marco Santarelli. He is a household name for real estate investing strategy. He's been doing it for over a decade and was really one of the big influences on my real estate investing as I began to do that many years ago. So today we're going to talk about what he's doing in the market, how he's investing, where he's investing, what he sees for the future of real estate, and ultimately we're going to be talking about any trends that we see in the real estate market. So this is a really great episode, a lot of detail here, a lot of advice, and a lot of concepts, and I hope you enjoy. Welcome, everyone. I have a special guest today, a guest that I've listened to for a number of years, who really was, a big bulk of some of the reasons that I started investing in turnkey rentals, 7-8 years ago. And I think he's a very honest, straightforward guy when it comes to real estate. There's no fluff in his content, which I love. And so his name is Marco Santarelli. He's a household name. And today we're going to pick his brain on what he's doing in real estate, how he's planning his portfolio, and ultimately what he sees ahead for the real estate market. Marco, how you doing?
Hey, great, Tom. How are you?
I'm well. Thanks for joining. It's very sunny down there in SoCal, huh?
It's almost always sunny in SoCal. It's the sunshine tax that we pay here.
Sunshine tax, exactly. Cool. So for those that don't know you, I know you've talked to the Robert Kiyosaki's of the world, the Tom Wheelwrights, some really big names. Why don't you introduce who you are and what you've been doing as of late?
Yeah, I mean, pretty simple. I consider myself a serial entrepreneur, and at this point, a professional investor. I'm the founder of Norada Real Estate Investments. So for 17 years, we've been helping people invest in real estate, providing them turnkey rental properties in about 20 markets, U.S. markets. And, we have a note lending company and a finance company, but the core business of what we do is really just to help educate people freely and then help them build their real estate portfolios by providing them the people, tools, and resources that they need in order to invest in real estate. Why? Create wealth and create passive income. We all want financial freedom and we all want time freedom. And that's one of the best ways to do it.
Yep. Let me ask, so on that note, I talk to a lot of people who have primarily one source of income, their W-2. And I preach the idea of the amount of risk that is. Yes, you can always find a new job, but you are depending 100% on one avenue of income. What is your philosophy on just spreading out the risk across different income channels?
Well, I mean, there's a book literally written about the topic called Multiple Streams of Income, and people talk about that. I mean, the answer, I think, is pretty obvious. I would imagine to most people. Would you be in a better financial situation having one source of income being your job, which a lot of people mistakenly think is secure, as in job security, but that's not really true, because you can get fired or displaced, or something like COVID could come along and all of a sudden you don't have a job. So you're better off having multiple streams of income, multiple sources of revenue and income coming in than having one, because the risk is having fewer, not more. So keep your W-2 employment. Start a small business, make that income from a business. Also have passive investments, whether it's promissory notes or land development or hard money lending, or a passive stream of income from a real estate portfolio. So now you have a check in the mail every month. In fact, they don't mail checks anymore. It's really just ACH deposit right into your bank account. But if you have income coming in from different sources, businesses, real estate, promissory notes, hard money lending, et cetera, great. Now you have more stability. You have a better foundation. And that, to me, is less risk. The more income streams, the lower the risk.
Yep. Yeah. I mean, I would second that. 10, 11 years ago, when I started buying rentals, the genesis of it really was the idea of my job one day might be outsourced. I read this book about AI being our last invention, and it freaked me out. And I was like, okay, well, if my job is outsourced in 10 years, how am I going to make money? And so that was really the genesis of, okay, I need to figure out ways to have passive income or some sort of income stream beyond just my W-2. So I absolutely agree that having one channel in any fashion is just hyper risk.
Right. I agree.
Yeah.
And, awesome. Real estate is a great way to do that for most people, because, when I do my podcast, I position it as, learn how to invest in real estate, and as if you're a busy person. So most people are busy. They have a full-time job and a career. They have their family. They have, Johnny's soccer game on the weekend. they have whatever they do with their friends and family, and that's not, including other things like running errands and going on, traveling, when you can travel. So if you're that busy, if you have that many demands on your time, then what you should be doing is investing in investments that generate the greatest amount of wealth and passive income, but take up the least amount of your time. And income producing real estate, residential real estate, is one of the best, if not the best, investments to do that in. And as of 2017, residential real estate investments have become the best and most favored most tax favored investment class out there. It's now better than oil and gas. Oil and gas used to have the greatest tax benefits. Now it's income producing real estate. So there is no other better investment to make than income producing real estate, like residential real estate.
Yeah, I would second that too. And I have a video that walks through the different aspects of the total return of real estate. And it's one, you're able to leverage by taking out loans to maximize your returns. Okay, so in my opinion, it's the best time to be doing this if you can find the good deals in the market. It's just a phenomenal time to be doing real estate investing. So let me pick your brain a bit more. Again, on your podcast, again, there's a lot of episodes, a lot of great content, and for everyone out there, I'll put the link down below where you can find that podcast. But you talk a lot about strategy and whatnot, but I want to hear where you see the real estate market going in the next, let's say, 18 to 24 months.
Well, first and foremost, we need to kind of establish a truth or a fact about real estate, and that is that there's no one real estate market. The media likes to talk about real estate in terms of the housing market, and that implies that the U.S. is made up of one real estate market. And I know what I'm talking about, but for people who are listening to this, the United States is made up of over 500 metropolitan statistical areas, or MSAs for short. Knowing that, what happens in one market is different than what happens in another market. The dynamics and the drivers are different. So what happens in, let's say, Austin, Texas, where you live, is different than what's happening in San Diego, just south of me here, which is different than what happens in Detroit, Michigan, and it's different than what happens in Las Vegas. So knowing that every market is different, it implies that it means that there's different opportunities in different markets and different things are going on. So the future of the real estate market is going to be determined by the drivers in that market. And usually, more often than not, the two main things that drive the market are jobs and job growth and population growth, whether that migration is net positive or net negative for that, because that increases the demand or decreases demand. And that affects prices in terms of the housing market and in rents. So you need to get granular. In fact, I take local real estate beyond that. I call real estate being hyper local, because even within a metropolitan area, you've got submarkets and then neighborhoods, and what happens within one neighborhood and one submarket is different than across the tracks on the other side. So I just want to clear that up before I answer the question of where do I see real estate going.
Agreed.
In general terms, I'm very bullish on real estate, pretty much across the board. And the reason for this is because we have a situation right now where we have a lack of supply and we have very strong demand. The demand is also increasing. So we need approximately 1.62 million housing units each and every year just to keep up with regular demand. The problem is we're not producing that much. We are short by 300,000 to 400,000 per year.
Yep.
Freddie Mac actually predicts that by the year 2030, which is less than 10 years from now, we're going to be short anywhere from 1 to 4 million housing units short. I don't think they're actually including in their calculation what I refer to as shadow demand. Right now, there's a lot of young people living at home, young adults that are between the ages of 19 or actually 18 to 29. 52% of those people, that demographic, is actually living at home with their parents. So what happens when this demographic goes out into the world and they're looking for their first rental, their apartment or first rental to live in, or their first property to purchase as a home? It's just going to increase demand. So we have a shortage in housing, strong demand, tight supply, increasing population, and we've got Gen Y and Gen Z just waiting to get out there. They're already starting to buy. I mean, they drive 32% of the affordable housing purchases in the country right now, but that's been held up or pent up because of COVID. that's going to open up. Now, all of a sudden, you're going to have more people coming onto the market. And I'm not sure that even baby boomers are releasing their existing inventory. They're staying put.
That's
So
right.
they're just exacerbating the problem. So strong demand and lack of supply means that property prices are going to continue to increase. And if you're on the right side of this equation, like if you're a real estate investor, you own property, you're going to benefit handsomely.
Yep.
But if you're not in the market, if you're not in the game, you're going to miss out. You're going to kick yourself 2 years from now, or 3 years from now, or 5 years from now.
Yep. Yep. Agreed. I mean, all those points, in the first two that you mentioned about the job growth, so in my videos, when I talk about forecasted appreciation in markets, I talk about the median income growth rate, right? And that's based on job demand as well, or types of jobs or job growth. The higher the income, obviously, the more they can afford to buy, and therefore they put more demand on prices, right? And of course, population growth, right? If population is growing faster than the housing units being put on the market, again, you have a unbalanced supply and demand, and that's been seen across a lot of the South, a lot of the Southwest. I mean, even parts of the Midwest now are really short on supply. So it's really a supply shortage problem across the nation. So just yesterday, I believe the number came out, year over year price growth of 9.5%. I mean, that's a phenomenal return. I also have a graph that I'll put up here for all you viewers. Over a 34-year period, when you compare real estate to stocks and include volatility and everything else, stocks has lagged between 3 to 5% annually against real estate, right? And that's when you think about the volatility that you have to pick up to own stocks versus a rather stable asset like real estate, it's kind of a no-brainer, right? And so, I'm with you. I think there's a lot of tailwinds with real estate. I don't see the supply getting back to normal levels, even if there's a massive foreclosure wave that everyone's predicting. I still think that's going to be segmented into the C and D class, not necessarily the B or A class properties. At least that's my theory. And so I think to your point, I see substantial returns just from the appreciation standpoint for at least 5 to 10 years ahead. So that's great. So knowing all that, what are you doing in your personal strategy to, I guess, realize the most amount of upside in your portfolio?
Well, I'm continuing to invest. I mean, I'm buying properties right now in Wisconsin and in Florida. Wisconsin is more of a cash flow play for me. It's kind of, these are what I refer to as boring markets. And we have a number of them, depending on what our clients want, we put them into the boring, cash flow markets, or we put them into the more exciting, strong growth markets for that appreciation potential. Nobody has a crystal ball and can guarantee that you're going to get appreciation, but the cards are obviously stacked in your favor. But Florida is the market I'm looking at right now, to build a small footprint there for capital growth, because a lot of people are moving to Florida. The last numbers I read were 610 people a day are moving into the state of Florida. So that just increases demand, and they're not keeping up. We work with about we work with about 6 builders in Florida to provide us the inventory for our clients, and they're behind. I mean, you're not buying any standing inventory today. Everything you're buying is pretty much pre-construction. So, you're basically picking a lot, signing a reservation agreement, and then they're going to start building, and you'll get it in whatever, 3 to 6 months, depending on what stage they're in. So my personal investment strategy is to keep investing in markets that are growing, that the numbers make sense, because obviously you want positive cash flow. Even if your strategy is strong price growth, you still want positive cash flow to carry the property. That's the glue that holds your deal together.
Yep, agreed. In fact, I'll tell you from my own development in Arizona, we list properties before they're even done being built. Basically, the second we get permits to build, we're putting them out on the market, and they're selling pre-build before we have any power lines in the ground or anything. So, I mean, it's the demand. Wow. Demand is real, and this is not near Phoenix. This is 2 hours west of Phoenix, so a pretty sparse population, and the demand there is, well, really, it's the inventories. It's just so short, and I think that's really in fact, you saw some recent reports on the new housing starts or permits. So developers are still picking up on the permits, still below what you're talking about on the 1.7 million unit required to meet demand, but they realize that there's opportunity now to build more houses. So, yeah, I'm with you. So, yeah, I tell my clients too, you do have to diversify across your asset classes, whether it be cash flowing properties in Kansas City or Wisconsin. I assume you're in Milwaukee.
It's actually outside. It's more of the exurbs,
Okay.
south of
Yeah.
Milwaukee. Yeah.
Yep. And then I think that, I also tell them too, you do consider where population is moving, which is the South and Southeast. So parts like Florida, parts of, Texas, Houston, all markets, I believe you're also in as well in your portfolio, right?
Correct. Yeah. It's mostly it's made up of parts of the Midwest, the South, and the Southeast. I mean, that's predominantly where things are happening.
Yep. Agreed. Awesome. Cool. So on that note, it's one thing to buy single family homes, but there's a lot of new trends happening in real estate. There's talks of converting old malls into housing. There's a big wave coming, I think, of build to rent properties. And then of course there's, I think, a lot of the late stage syndications that, the standard storyline of a C-class property, making it a B, selling it at the same cap rate. Those stories are becoming weak now, as you see collections dropping. So beyond those, I mean, are you seeing any unique trends in the market that many people might not be seeing right now in the news articles?
Well, there's two trends. First of all, on the commercial side, I don't spend a lot of time in commercial real estate. It's not my wheelhouse. I watch it at a 40,000 foot level. Clearly, retail has been suffering, in the last year or so because of COVID. Warehousing and light industrial and whatnot, they've been doing very well. So is that going to continue? I think that trend will continue for a while. Storage has also been, interestingly enough, on fire. Storage facilities and investing in, storage. I don't know exactly what's driving that. If it's, what from COVID is driving that, but apparently they're just booked up and cap rates have been going up in all kinds of storage type investments. On the residential side, the trend that I see going on there, and it's been going on for years, but it's expected to increase here over the next 5 years and continue for the next 10 years. And that's the whole build to rent model. So builders building property, homes, single families, even duplexes and fourplexes, specifically geared towards tenants. Now, a lot of these are really nice, like they're high end. In fact, it's the product type that you would say, oh, wow, that's gorgeous. I'd live there. So it doesn't matter whether you're renting or buying it. It's just beautiful product. But they realize that we are a renters nation, and that is increasing, and they're just catering to that demographic. And the problem is that we still have tight supply, like I was talking about before. We have a lack of inventory, and so they've realized that there's a whole market out there to build product that's for landlords or investors specifically, that caters to investors. And so they're looking at, areas to build 3-bedroom, 2-bath homes that cater to that audience. And they're doing extremely well. In fact, they're very bullish on this area. And that's going to continue for the next 5 to 10 years. This whole build to rent model is huge.
Yep. Agree. Yeah. I mean, we considered the model as well. I think for us, it was more, well, do we want to manage properties or do we just want to sell them? I do see big upside. I think there's a team that you also work with Steve Olson at Fig Real Estate. I believe you sell those properties. Those are really great fourplex, brand new builds. And again, for all you listening, I'll put a link to Marco's site if you want to get in touch with them to talk about some of these new builds in Florida or in other parts of the nation. So great.
Yeah, Steve is actually Steve is a great guy. He's one of my investment counselors here.
He is.
He's been on our team for, probably 7 years. Nice. But he's our point person with some builders so we drive everything through him as the conduit just to keep things organized. But Steve's a great member of my team, and we've got 6 great investment counselors.
Small world. Yeah. That's amazing.
Yeah.
So I know that, again, I put out a lot of content. I know you have some free books and free guides. Where can people get in touch with you? Let us know, what you're offering, where you're offering. How do we get a hold of Marco and his team?
Yeah, well, that's really simple. We have 2 websites. Our mothership, if you will, the core website is noradarealestate.com, NORADA. And the sister website is the name of the podcast, which is actually the home of the podcast. And that is passiverealestateinvesting.com, named after the podcast, which is Passive Real Estate Investing.
Yep.
But yeah, the contact form just reaches my team, my assistant. And so anytime you fill that out, everybody's looking at it. So, you'll hear back from somebody pretty quick.
Right. And I think there's one of those sites does offer a free guide on passive investing. And so check those out, and that's free for yours. So Marco, it's been great. And hopefully we'll talk soon.
Tom, good luck with everything. Thank you so much. It's been a lot of fun today.
Thanks.